On day one, the system does not tell you that your money is gone. It tells you to wait. An ATM limit appears. A transfer stalls. A branch closes early. Nothing looks dramatic yet. But in banking history, this is often how the trap begins. By the end of this video, you will understand why the first 72 hours matter more than the public panic that comes later, and why that short window often determines who keeps flexibility and who loses it. Because a bank freeze is not just a banking event. It is a controlled interruption of access, and once access begins to break, the balance in your account matters less than most people think. So let's reconstruct the first 72 hours of a bank freeze, step by step, and look at what the system is really doing while the public is still being told to stay calm. This is the part most people misunderstand. They imagine a banking crisis begins with crowds, shouting, and public panic. But the forensic record shows something colder. Access breaks first. Narrative follows later. That order matters. Because once you can no longer move money freely, the system has already crossed a line, even if no one on television is willing to name it yet, and the language is almost always soft at the beginning. Temporary limits, operational delays, technical maintenance, precautionary measures. Customers are reassured. Service is said to be normalizing. So this video is not about panic at the end of a crisis. It is about the quieter phase at the beginning. The phase where friction is still small enough to dismiss. The phase where institutions buy time by slowing you down before they tell you what the slowdown means. And here is the forensic thesis. In a real bank freeze, the first loss is not your balance. It is your freedom of action. Hour zero does not announce itself. It arrives as friction. You try the ATM. The number is smaller than expected. You try the transfer again. It stays pending. You call the branch. No answer. Or worse, a calm answer. Technical issue. Temporary delay. Please try later. And that language matters, because in the first 12 hours, the system is not trying to explain the truth to you. It is trying to buy time. Not by saying no, by slowing yes. That is the first mechanism. A hard freeze is politically explosive. A soft obstruction is manageable. So the first move is rarely dramatic. It is a sequence of small interruptions that look survivable in isolation. An ATM cap, a delayed wire, a branch that opens late, a card payment that works in one place and fails in another. Each event is deniable on its own. Together they form a message. Do not move quickly. Do not test the perimeter. This is why the official tone stays so gentle in the opening phase. Deposits are said to be safe. Service is being restored. Operations are normalizing. But if your money is safe and your access is impaired, the question is no longer solvency alone. It is control. And the people who recognize that first are almost never the public at large. It is the person who runs payroll on Tuesday, the importer waiting on settlement, the family member trying to move money for a medical bill, the pensioner who learns too late that available balance and cash in hand are no longer the same thing. In Greece, when capital controls were imposed in late June 2015, banks shut and withdrawals were restricted to 60 euros a day. At street level, it looked different. It looked like queuing, failed routines, and people discovering that the payment system they trusted yesterday had become conditional overnight. One of the clearest images from that period was Georgos Chatsifotiadis, a 77-year-old pensioner in Thessaloniki, who queued at multiple banks trying to withdraw 120 euros of pension money for his wife. By the fourth bank, he broke down in public. Not because the money had vanished from the ledger, because access had. That is hour 0 to hour 12, not collapse. Calibration. By hour 12, the problem is no longer the machine. It is the perimeter. Because once enough people test the exits at the same time, a stressed banking system stops thinking like a service business and starts thinking like a containment operation. Publicly, You still hear reassurance, stability, temporary measures, protection. But operationally, the logic hardens fast. Outflows are watched, exceptions narrow, payment rails slow, and a bank holiday stops sounding unthinkable. That is what containment looks like in the first 24 hours, not a cinematic ending. A narrowing. And the people who feel it first are usually not the people who trust official language the most. It is the saver who attempts a transfer to another institution and watches it stall. It is the small business owner who realizes tomorrow's supplier may demand cash. It is the employer who understands that wages sent on paper are not wages received on time. And that behavior creates the next problem. Because once households begin testing cash access and businesses begin testing settlement reliability, liquidity becomes psychological before it becomes mathematical. A banking system can survive a great deal of fear. What it cannot survive is synchronized disbelief. That is why the first official restrictions are not just pauses. They are sorting mechanisms. They separate the people who still believe the inconvenience is temporary from the people who understand that the inconvenience is the event, and the gap between those two groups is where most of the damage happens. By the end of the first 24 hours, the sophisticated actors are no longer asking whether their deposits are there. They are asking a colder question. What can still clear? What can still settle? What can still be converted into something usable before the next announcement? Because once a system reaches containment, delay stops being a symptom. It becomes policy. By hour 24 to hour 48, the system has a new problem. Because once enough households understand that bank money and usable money are no longer the same thing, they change their routines all at once. They withdraw what they can. They postpone payments. They hold notes longer. They start asking which merchant still takes cards, which pharmacy wants cash, which relative has cash at home, which bill can wait, and businesses feel it even faster. A household can improvise for a few days. A shop with inventory cycles cannot. Payroll cannot. Importers, wholesalers, pharmacies, fuel distributors, and any firm that depends on predictable settlement begin to feel the stress before the public language catches up. This is where confidence fractures before official admission. Not because people become irrational. Because daily life starts producing evidence. The ATM works, but only up to a limit. The transfer exists, but does not clear when expected. The card is accepted here, rejected there. The branch is open, but not functioning as a branch used to function. And every one of those small failures teaches the same lesson. Money inside the system is becoming conditional. By hour 48 to hour 72, the freeze stops feeling universal and starts feeling stratified. Because pain is not distributed evenly in a banking restriction event. It sorts people by access to alternatives. If you already have cash outside the system, you have time. If you have income through another channel, you have options. If you can settle through foreign accounts, supplier credit, or pre-existing liquidity buffers, you are stressed, but you are not trapped in the same way. But if your entire life runs through one domestic banking rail, the third day is when the trap becomes visible. Not theoretical, operational. The public language is collective. We are stabilizing the system. We are protecting depositors. We are ensuring orderly functioning. But the lived reality is selective. The retiree at the ATM is not living the same crisis as the exporter with foreign receivables. The small shop paying cash for stock is not living the same crisis as the firm with prearranged credit abroad. The family waiting for a domestic wage transfer is not living the same crisis as the household that already kept notes, medicine, and a second payment path outside the bank. In Cyprus in 2013, that hierarchy became visible fast. Temporary capital restrictions included limits on cash withdrawals and controls on transfers designed to stop deposit outflows while the banking system was restructured. That is the key point. Delay is not neutral. It allocates damage. By the third day, a bank freeze is no longer just about liquidity management inside institutions. It is about who can still convert claims into life, who can buy, who can settle, who can wait, and who cannot. What history keeps showing is brutally simple. Public panic is late stage. The real damage starts earlier, when access is impaired but the official story is still trying to preserve calm. That is the buried lead. Not that systems fail, that they fail selectively and in sequence. First movement, then confidence, then narrative, and by the time the public calls it panic, the most important sorting has already happened. So the closing takeaway is not fear banks. It is narrower, colder, more useful. In any financial stress event, do not begin with the question, how much money do I have? Begin with this one. How many ways can I still reach it, move it, spend it, and settle with it if the primary rail slows down tomorrow? Because a bank balance is a claim. Access is function. And when systems are stressed, function is what keeps you fed. If you want the next stage in this trap, watch The Weekend Before the Bail-In.